Hello, Tim Suffish here with an investment update. It is currently the beginning of May 2014, so we're about a third of the way through the year 2014, and so far so good. If you look at the U.S. stock market, the Dow is up a little bit, the S&P is up about 2.5%, and bonds have recovered up about 3% after 2013 when they traded down by 2 to 3%. So the view from 30,000 feet is that stocks are up, bonds are up, stocks are at their all-time highs, and bonds are about at their one-year highs, and that's all good news. When we look beneath the surface, there are, as is always the case, there are things to take comfort in and to certainly invest based upon, and there are also things to be concerned with. I'm going to run a few of the things on each of those sides of the ledger for us right now. On the plus side, companies are doing well. Earnings are strong. We're at record earnings for S&P 500 companies. Profit margins are at a very high level. Companies are flush with cash. If you look at cash as a percent of current assets on balance sheets, we're at a level of about 30%, and that's compared to being less than 20% back in 2007, 2008. So companies are doing well selling their products and services. Margins are high, which means that cash is building up within companies. That's kind of the normal flow of things through the life cycle of sales and the accounting for those sales, and those are all positive. Companies have that cash on the books and they're doing good things with it. They're returning cash to shareholders through things like share buybacks and also through dividends. And if you look at the trend over the past couple of years for both share buybacks and dividends, we've seen a nice increase from the levels back in 2008, and that's certainly a good thing to pay attention to, and it's a good thing for us as shareholders. One thing that had been at a relatively slow pace since 2008, considering the cash that's been building, is merger activity, and now in late 2013 into 2014 we're seeing merger activity pick up, and just in the past few weeks we've seen a big deal, or a big potential deal, announced by Pfizer in an acquisition of AstraZeneca, and there have been other notable deals of much smaller size that are a good sign. So again, taking a step back and putting your mind, kind of thinking through the lens of a corporate CEO for merger activity being a strong indicator to look at. We see it as a very positive sign when CEOs are out there and willing to undertake merger activity and acquisition activity, because it takes a lot of confidence in your business and somebody else's business to go out and buy them up. In the case of the Pfizer AstraZeneca deal, we're talking about a transaction north of $100 billion, and that is big and meaningful, and it shows a lot of confidence in the business climate. So that's a good thing. On the flip side of the ledger, we're starting to see some rotation out of the more aggressive parts of the market. If you look at the small caps like the Russell 2000, they are the smaller companies. So while we typically invest in portfolios that consist mostly of big blue chip companies, $50 billion and up, for the average portfolio, the Russell 2000 is more like the $1 to $3 billion company, and the Russell 2000 in that more aggressive part of the market is starting to show some weakness. And as of right now, compared to the high for the Russell 2000, the current levels are about 7 to 8% below that high level of just a few months ago. So there's a little bit of a rotation coming out of the aggressive parts of the market. If you dig down into individual sectors and stocks and you look at things like the social media stocks, that would include Twitter, which has just been a public company for about a year, and also Facebook, which has been a public company for about 2 years. Both of those are down pretty meaningfully from their highs. Twitter down by close to 50%, Facebook down by about 15%. Also Amazon, a mature company. Amazon's been around for close to 20 years now. But Amazon is an aggressive, high PE stock. It's also growing at a very rapid rate, but a high PE stock nonetheless. And it is down by about 20% from its highs just a few months ago. So the small caps and those more aggressive stocks are starting to see some rotation. So far, I'd say it's been a very healthy rotation into the bigger blue chip type names. But nonetheless, when the aggressive part of the market starts to show cracks and signs of stress, we kind of sit up and take notice and want to make sure that it doesn't become something more serious. The low yields that we're seeing, so I started off by talking about how we've seen a rally in the bond market so far in 2014. That rally has brought interest rates to more or less a one-year low. If you look at the 10-year U.S. Treasury, it's at about 2.59% today. The 30-year Treasury is at about 3.36% today, and those are very low levels. I think on the 30-year, it's almost a one-year low. And while that's a relatively good thing, when we're investing in stocks, we'd rather see interest rates low so companies can finance their business at a low rate, just like we as consumers like to have low rates when we borrow for an auto purchase or borrow for a car purchase. That's also good for companies. A low interest rate environment is good for companies, but having rates as low as they are, it's something that, again, we pay a little bit of attention to because it's a sign of stress in the market. Investors are gobbling up bonds, pushing those yields down, and in some ways it's due in part to a little bit of nervousness in the minds of bond investors. So again, nothing to be too concerned with, but it's something that we're paying attention to make sure it's not leading us down a path we don't want to go down. Also, the Russia-Ukraine situation is getting back into the headlines today. It's been simmering for the past month or so. The market so far has not been too concerned. Those interest rates that I just mentioned, I think in part are due to what's going on in Russia and the Ukraine. Interest rates coming down, again, it's a little bit of a flight to quality, and that is certainly a natural response and what we typically see when there's a little bit of nervousness around geopolitical activity, and Russia-Ukraine certainly fits that bill. Finally, valuations. So how richly or cheaply the market is valuing stocks is something that we pay attention to. And with the run that we saw in 2013 and what we've seen so far in 2014, the market is, I'd say, still on average reasonably priced, but we're up against the higher end of the range. So it's, in our view, not a time to be aggressive. Distilling all this down, the takeaway is that at the margin we've sold a position or two, we've trimmed a position or two, especially in situations where the stocks have run and gotten to levels where their prices and their future growth potential couldn't really be justified. And in most cases, we've decided not to or in some cases decided not to reinvest that cash. So our cash levels are a little bit higher than average. And that's something that we're very comfortable with. So although there are very good points about the market and some things to be concerned with, we're raising cash at the margin just to be cautious, I think. So net, it's been a good first 4 months of the year, and the trends are good. Again, we tend not to look at individual data points. It's all about the trend, and employment is going the right direction. We actually had a really strong employment number today, 288,000 jobs added during the month of April, and the earnings trends are good. And employment and auto sales, home sales were a little weak, but that's one number out of many. So overall, things look pretty good. Thank you, and talk to you soon. Bye.